A lot of these founders are in denial about their finances. They're pushing off this problem. If they could just earn another $4 million, maybe they'll solve it. They'll get the right VP in. What does that mean to you? What do you tell these founders that are grinding and they just think the answer to all their problems is more revenue?
Yeah, I see this all the time. And founders are, so prone to getting stuck in this hustle, grind away. And they always, fall into this trap of thinking, okay, if I can just work, one more hour or get this latest tool or this latest technology or a better agency. And, they get sucked into thinking that the way to digging themselves out of these revenue problems or growth challenges that they're having is to just, grind harder. I'm a big advocate of working smarter, not harder. Yeah. And really what I work with these founders to understand and come to appreciate is that if we can form a more productive relationship with our financial statements, and if we can understand what those tea leaves are trying to tell us, then we can actually be a lot more strategic about how we allocate our scarce time, our attention, our team resources, our capital, and put investment into the things that the business really, really needs. Understand, which are the 2 or 3 problems that are actually holding your business up, whether it's in terms of reaching your revenue goals or your profitability goals, or maybe both, rather than, just trying to do everything and continually grinding and hustling away.
What are some of those tea leaves? I have a theory. So I've worked for CFOs and CROs for 12 years now. I'm passionate about supporting both of them, but you guys view the business differently, right? The CR has maybe not, you have the same problems, but you have different objectives and different ways of getting there. So I'm fond of saying that if you want to start a business, you have to do it with a salesperson and a product person. And if you try to start with the finance person, you might not get too far. But you absolutely have to have a finance person to run a successful business. So what are some of those tea leaves? And if you can think back, like an example where you had a hard charging founder and you're like, hey, let's step back for a minute here. This is what the writing on the wall is, and here's how we can make better decisions.
Yeah, absolutely. So first thing I'd say is that I can often detect or deduce quite a bit about a founder's personality profile by looking at the financial statements that the company is generating.
That's so good.
One such example is a metric that I really like called revenue per SKU. So basically, how much sales are we generating per widget that we have available for sale? Yeah. And I specialize, as I think, in e-commerce and, consumer goods. So it's all, physical product type businesses. Yeah. And I have seen this number range anywhere from $5,500 a year to about $7.5 million a year. That's
per SKU? For sure. So for 5 SKUs in there and one of them is just barely trucking along, but the other one's making them $5 million?
No, we're talking about like whole of company averages here. So I take all of the revenue for a business divided by the number of SKUs to get this, company-wide revenue per SKU metric. Now, when you see a very, very low revenue per SKU, that's usually a telltale sign that the founder of that business is the designer, the creator, the subject matter expert. And they often fall into the trap of thinking, hey, the answer to my revenue problems is that I don't have enough things to sell. If only I had more products and more options and things for people to buy, then I would be, having more customers. Therefore, I need to put out more widgets and make them available for sale. And so you end up with these gigantic catalogs that are unbelievably burdensome from a inventory operation, supply chain perspective to manage and keep tabs on. You end up with catalogs where you might have 15% of the catalog that's generating 80% of the revenue or profitability of the business, and so the other 85% of the catalog is just taking up space and costing you money in storage.
They are
fees.
Just to be clear. Even a SaaS company, so I used to manage catalogs through the channel, even for SaaS companies, and they still will rip through thousands of SKUs, and the labor intensity in that of trying to export all the data, get it back to the partners, get it into your configurator software, et cetera, it's big, and I agree with you. I think that a small, well, the cliche is like 20% of them are probably making 80% of your revenue.
Yeah.
But you know what's so funny about what you just said is, see, I know that I'm biased towards salespeople. I've had a long career. I've made a lot of money supporting salespeople. But you just presented the blind spots, right? Of someone that's just creating. What's that saying? Like, if you have a hammer, then every problem is a nail. It's like,
Yes,
so for
exactly.
them, when they go after it, they're just going to throw more products. What I've seen on the CRO side is they'll look at things regardless of product, and they'll just start saying, we need more leads, we need to throw more prospecting at it, we need more sales process, et cetera. And they might underappreciate how little a product is meeting the market needs or matching the market needs. So so essentially you said, I can look at the skeletons in the closet or like raise the hood, and I'm learning a lot about the founder. What else are you seeing there? Product people creating too many products. What are other things that jump out to you?
So I see three main founder archetypes. The first one I just described is the designer, product person, or the subject matter expert. Then I often come across the digital marketing, paid media guru. These guys have usually got pretty tight numbers when it comes to looking at CAC and lifetime gross profit.
Yeah.
They've usually got much smaller
I'm glad you put them in a separate bucket, though. I do. They are near and dear to my heart, but like you're in a separate bucket.
This is probably your crowd.
You start
I
with
suspect.
paid media. Yeah.
So
you start with paid media and you're tracking numbers well, but there's more to a business.
Yeah, so when you dig into the ad accounts, you can see a healthy relationship between CAC and lifetime gross profit.
That's right.
They have got, decent repeat business. And these sorts of founders, as long as they understand and are keeping tabs on the CAC and lifetime gross profit ratio, and that's continuing to look pretty good, they're usually quite content, at least in my universe, to keep doing that. And quite frankly,
they make $1 million a month with 2 employees and 5 contractors. God bless them. They're content.
Yeah. Well, the example I gave you earlier of the guy who had a revenue per SKU of like 7.5 million, he was one of these profiles, right? He was a paid media guy. He understood ads and creative and TikTok and blah, blah, blah. And so he was doing, really, really well at that. So they usually have much simpler catalogs. They've got healthy economics around the paid media stuff. But truthfully, I find that they don't always make the best CFO clients. And the reason for that is because their world in terms of the types and complexity of decisions that they have to make in terms of both sourcing capital and investing capital, which kind of when you think about it is a big part of what a CFO helps with, is pretty simple, right? They know where their next dollar is going to come from. It's going to come from a profitable sale of a product. And they also know exactly what they're going to do with that money when they get it. They're going to buy more ads and more inventory. It's pretty freaking vanilla. And so
they also have an email list of 2 million that if they ever get in trouble, they're just going to toss an offer out there, make a quick million, bail themselves out. Yeah, they're a fascinating bunch. I really do. I follow Jeremy Haynes. I don't know if you know his work, but I do a lot in the ad space for the small business side.
Okay. Yeah, well, these guys, as far as interacting with people like me, I find they're usually content with having a bookkeeper or accountant basically follow them around and kind of clean up
But
the
what
mess.
about keeping them out of jail? Do you see that as like a CFO responsibility? GAAP principles, doing this smart,
Yeah, I think at a point, I mean, depending on the trajectory that they're on, it's likely that eventually they might run into TAM issues or they might run into marketing efficiency problems. And as the margins get thinner and, the competition gets tighter, the financial numbers can start to break down. And I think it is, upon these types of founders to really be astute and aware enough about the financials to understand when they're starting to head towards problems and when they should potentially bring in some more finance type support.
Well, so then maybe let's unpack that for a minute, because some people, if you say you're a CFO, some people might instantly think, okay, you're a CPA is a what? Certified public accountant. That's at least on the U.S. side, and you rose the ranks to just be a really high-ranking accountant.
Yeah.
So I actually heard you say something different. You almost just said, like, if you need an accountant, go get an accountant, but that's not me. I'm a CFO.
Correct. Yeah, I'm not a CA,
Yeah.
CPA. And there are CFOs out there like this. I would call them more of a compliance type person. They'll help you with your QSBS. They might guide you on tax. I don't do that. I am much more closer to the co-founder on demand. Is my business model and how I operate. So. My background is I used to be an e-com founder and CEO, co-founder and CEO myself. So I've been in the trenches. I've gotten my hands dirty. I've solved the HR problems, the legal problems, the inventory problems, you name it. I've worn the hat. And prior to that, I spent about a decade on Wall Street. So really what I bring to the table is, institutional finance knowledge, plus now about a decade or so in the trenches in the e-com space. So people tend to work with me, and I jive best with founders who are wanting a strategic thought partner around their most difficult decisions. They might be brand oriented, product oriented, they might be great at marketing, and perhaps intuition and gut instinct have gotten them a fair way. But as the numbers get bigger and you get more and more zeros after them, and as the margins get skinnier and skinnier and the decisions get more complicated, it's harder and harder to rely on gut instinct and intuition alone. And eventually a founder's going to come to a point where it's like, okay, I actually need someone who can crunch the frickin' numbers here and tell me what the data is saying. That's kind of the role that I play.
So I want to, let's talk about who you like to serve the most and how you're serving them now, but I want you to finish the 3 buckets. So we talked about product-led. We had the e-commerce guy in the middle bucket. What's your third bucket that you see?
The third bucket, I call them the business owner. And these people aren't necessarily wedded to any one discipline. It's not like they're a master creative or a master media buyer, but they're a bit more multidisciplinary.
I call them sloppy entrepreneurs. I think we're about to describe the same person. Let's go for that. Let's go down that
Jack of all hats,
rabbit hole.
master of none, maybe. So, they dabble in everything. I have found that they tend to be a little bit on the older side. I don't have too many clients in their 20s and 30s. Guys and girls in their 20s and 30s are still highly confident, still, have enough time in life to bounce back if they make a big mistake. By the time these people get into their 40s and 50s, they're usually a bit more conservative. They've usually been around the block a few times. They've experienced some failure when it comes to managing of finances. They know what a mistake feels like because they've lived through it. And they're like, okay, I don't want to do that again. That wasn't cool. I just missed out on $1 million purchase order because I didn't have enough inventory. Let's not repeat that. Can I get some help, please? So this third archetype represents, I don't want to put a number on it, but certainly the vast majority of my client portfolio. These people tend to be most receptive to coaching. They've experienced the pain of not having someone like me. And so, frankly, it's a lot easier to sell to them.
Yeah, so they're problem aware in the market, right?
Yes.
But now, do you find of these 3 archetypes, are they seeking you out? Are they looking for you? Or have you just been able to say, hey, congratulations on 20 years of growing your whatever HVAC, storage facilities, or service industry. Here's some things you might not be thinking about, and here's how I can make the next 20 years of your life super comfortable. Like, how do you approach that, not really a pitch, but how do you approach that market fit for them?
Yeah. So I have not had a huge amount of success with cold outbound, if I can be honest with you.
I think it's overhyped, and I actually don't think it works for the kind of things that you and I do. I agree.
Right. Okay. So I don't do a lot of that. Where I have had the most success in terms of sales is founders who are experiencing one of 2 problems. Number one, there's some level of discontent about the financial outcomes that they're achieving. And that could materialize in the form of they're not paying themselves enough. They're not paying themselves consistently because they are prioritizing things like, inventory investment, purchase orders ahead of, themselves. Or they're sitting there doing millions and millions of dollars a year, busting ass, working harder than ever, but none of it seems to be accumulating in the bank account at the end of each month. And they're like, WTF, like, what's the point of this? Why am I working so hard doing all this work if none of it, this wealth is accumulating to me? So that would be category 1. Category 2 would be people who are overwhelmed by choices and options. And they're like, I want to bring on this salesperson. I want to launch this product. I want to open up this new channel, but I don't feel confident committing to any of these things because I don't know, I don't really understand the pros and cons of them. So they're starting to feel growth constricted because they do not have confidence in the decisions that they know that they need to make. And there's some big dollar signs attached to these things. These are not, cheap experiments to be running. And they just want someone to come in and help them. When I onboard these sorts of people, as part of my onboarding process, I try to extract out of them what is their list of priorities and projects look like. So I hear about TikTok Shop, I hear about a new marketing agency, I hear about a new product. Like, there's typically 20 or 30 of these different ideas and opportunities. And partway through this conversation, I have to say to them, listen, I'm sorry, but when I hear you say that you've got 20 or 30 different priorities, what actually sinks in for me is that there's none. And we need to help you figure out like what the 2 or 3 priorities and real growth levers are for your business. And so I've got a whole process that I take them through subsequently to get that list of 20 or 30 down to 2 or 3.
Can you unpack that just at a high level? Does it boil down to just the numbers, or as a financial thought leader, do you also say like, here's ease of go-to-market, or here's quality of life, or this matches your mission more? Like what do you start unpacking for them to help to get from like 20 to maybe 3 actionable items?
Yep, absolutely. So there's 3 frameworks I use for that. The first one, as you alluded to, is financially oriented, and it's basically just looking at the ROI. So return on investment, or ROI, is basically an estimate of how much earnings could we potentially generate to this relative to the investment that we're making in it. And we can obviously look at ROI in terms of percentage terms. Higher is generally better. But you can also use those inputs to understand things like capital at risk, right? The I part, the investment part, which is usually some combination of dollars and time, is what we're risking if this doesn't work out, right? So we can look at what is the ROI, what are we risking if it doesn't work out, and how do the numbers balance out for each of these different 20 or 30 ideas. So that's filter 1. Filter 2 is basically a bottleneck analysis. And everyone, I'm sure, is familiar with the bottleneck. But in my world, we can apply that a number of different ways. We can think about bottlenecks in terms of capital or money flowing through the profit and loss. We could think about it as traffic flowing through the website. So, we might have a bottleneck at conversion rate or repeat order rate, or maybe it's AOV. Like, there's a lot of potential bottlenecks there. One of my clients at the moment is dealing with a fulfillment and operations bottleneck. We have had our foray into paid media and bringing on this new agency has gone so well that they've basically outgrown their own warehouse.
You'd think it'd be a good problem to have, right? But then you have a bunch of ticked off customers on the other side of it.
Exactly. So they've got a challenge now where they just cannot move any more orders through their own warehouse. They're self-fulfilling.
Interesting.
So, they've got...
What is that average order value? What's that AOV for them with the bottleneck now?
So their AOV's in about the 160 type range.
1,000, right? Just want to be clear. 160,000?
No, $160 per order.
Okay.
Yeah,
but
I mean,
still, they can't get enough out.
Thousands
No, I understand.
Of orders a month.
All right.
But
Yeah. So, but a lot at stake, just because they have more demand than they can fulfill right now.
Correct.
Yeah.
Yep. So we've had to throttle back the media buying so that we don't outpace the fulfillment capabilities. But anyway, there's a few different ways you can apply a bottleneck, and that's meaningful because from a business context, you are generally likely to get the biggest bang for your buck if you can remove the bottleneck in the flow wherever it happens to be. That allows more volume to go through. The third framework I use is probably not that traditional a framework for someone like me, but it's really, really important for the folks that I work with. And it's basically looking at skills alignment. I have this kind of axis that I borrowed from a guy named Sahil Bloom that categorize every task or function in terms of how good you are at it. And then we plot that against how much it energizes you, right? And how do you feel after doing it? And so there's 4 quadrants here. Obviously, the best quadrant is stuff where you're really, really good at it, and it also generates a lot of energy for you. But there's the opposite quadrant where you're not good at it, and it sucks and drains your energy. Now, this is really important for the smaller businesses that I work with because they don't have an Amazon.com style talent pool sitting in the back office. Right? We're talking about a small team with a very finite amount of skills, resources, and competencies. And it really doesn't make any sense for me as a CFO and project picker to put a ball in front of that founder, put a 30-pound bowling ball in front of that founder and say, hey, kick this 200 yards in the goal. Yes. Right? They're going to break their toe and the ball's not going to go in the goal. It's not really helping anyone. So I need to understand, like, who is this founder? What do they actually excel at? What is their team well equipped to support them at? And try to pick projects and opportunities that are aligned with the competencies of this team. And
it does happen. You do see that on larger orgs too, where if a CRO or even a department, if they're taking on something that really doesn't match the morale or energize them, it'll be a failure. So you had a closing thought on like putting that wrong project there, because I want to ask you a comparison between the 3 when you're ready.
Yeah, for sure. Yeah, closing thought is basically that, the right project and the right growth lever for one company or one founder is not necessarily going to be the same for your business, 100%. Right? Because you've got a different
I also
team.
think that's tough in that $1 million a month circle. They're constantly comparing themselves to the other person.
Yeah, all the
time.
time.
It's like, they'll hear something like, oh, this guy's selling hyperbaric chambers for whatever, $40,000. And I'm like, you don't like hyperbaric chambers, or you don't like health and wellness. Don't pour all your energy into paid media and infrastructure when you can't answer questions enthusiastically about why someone should even want a hyperbaric chamber.
Yeah.
That's an example of my own question. What I wanted to ask you is, do you have an example where you could say something might have had high return on investment, right? And we think everyone's financially minded. Oh, this is great. If I invest $100K, I'll get back $400K on this. That's a win. Do you have an example where you said, you know what, I really think that this $100K to $200K is a better fit for you, and you'll enjoy it more, and you'll do it more, and you'll keep cranking through it, and you'll make more money over a span of time? Like, what does that look like on your consulting side when you're mentoring these business owners?
Yeah, so I deal with a lot of small business owners, as I mentioned, and I mean it's different for all of them. I have had some examples of teams where frankly, some of these frameworks that I just shared with you have failed us a little bit. A recent one that's coming to mind, in fact, we identified conversion rate optimization as a big opportunity. I had benchmarked their website compared to a lot of other peers and said, hey, it looks to me like we're, maybe 0.5% below where we should be. And that might not sound like a lot, but
in
the
value,
e-commerce
that's a big
space,
deal.
we're talking, we're talking 1.2% compared to 1.7% conversion rate. Like, if you could close that gap, it's a freaking big step up in terms of revenue.
Yeah.
And they had an agency, and they said, listen, we can get these guys to help us with that. And we designed a whole, quarterly project around diving into this. Anyway, we got into it, got halfway through the quarter, and it became apparent that the agency, wasn't up to scratch, and the agency didn't have the competency that we thought they had, and the founding team also didn't have the competency to do this. And what actually ended up happening is we had to basically abandon the project halfway through the quarter because there just wasn't the skill set on this team to follow through. So
Interesting.
I've been pointing out to the founder, like, we need to fix this from a staffing perspective. And they're now in the process of replacing that agency and having another swipe at it next quarter. So it does happen. And candidly, that was, I guess, a bit of a failure on my behalf, our behalf, their behalf, in terms of selecting that project.
Yeah, but you caught it, you addressed it, and you pivoted decisively, and that's huge. I know a lot of people who would let that drag on for another year, just out of pride. I did want to point out that I worked for Webroot. They were about 40 million, I think, a year. They had a business to consumer arm. It's antivirus, like the stuff that sits on your laptop, and one of the guys, a young analyst, he identified on the landing page just a small little tweak made like a 0.5% difference in conversion, and that translated to millions of dollars. And so, he, whatever awards we had to give in the corporate world, like he won awards for that because he made one little pivot, and that consumer business is really what funded their B2B side, really.
Interesting.
No, so these aren't small changes. I don't think anyone should look at that and think a percent doesn't matter. Also, in my traditional world of revenue operations, sales operations, there is a whole arm called marketing operations. And so on the e-commerce side, this might look like Go High Level, Adio, or any other sort of, like, obviously the pay-per-click platforms are the obvious ones like Meta and Google. But on the business-to-business side, these are things like Marketo, Eloqua. These are hundreds of thousands of dollars of software that are trying to do a prospect automation. Like, it's a journey following the prospect through the what emails did they get, what landing pages did they come on, what did they click on, what do we send them next. It's nurture campaigns with the ultimate goal of getting people to convert. So this is, I think some e-commerce guys don't realize this. This is really big business for even billion-dollar companies. I was consulting with one of the large AI companies, and they were spending millions, and they would go to events and then upload all these lists, and all of that is automated marketing afterwards. So it still is very relevant to the billion-dollar businesses. What else, maybe before we move on, I want to hear more about your own e-commerce successes. But before we move on, like, what are some things you position yourself as a CFO, which is interesting to me. That's a very elegant position in the e-commerce internet marketing space. What are some other things people don't realize that they're losing out on by not having a strong financial lead or strategist in their corner with them?
Number one would be focus. I see this at the beginning of basically every new engagement that I take on. I mentioned before the process of coming up with this list and priorities, and founders are just spreading themselves too thin over too many projects, and often there's a tendency to bias towards the projects that are whatever lane that they've come from, whether they're a product person or a marketing person. Like, they'll over-index at those type of projects. But what I help them do is break apart the financials, do the benchmarking, and add the context to the financials so that we can actually understand what the financials are telling us about where we're strong or weak. So it could be that we've got a really wide, gross to net revenue gap, which is basically explained by discounts, coupons, refunds and returns.
Yeah, help me understand that just a little bit more. So, okay. So the difference between their gross revenue to to the bottom line, to net, is that right?
Gross revenue would be, what you earn from selling a single product for $100.
Top line.
You might net 75 because the difference is with 10% welcome offer or refunds and returns or other sort of stuff.
And you called that what?
The gross to net ratio.
Okay, gross to net ratio. All right.
So then kind of moving through an e-commerce P&L, you've got the gross to net, and then you've got, like a gross profit ratio, which is determined by a cost of goods sold. Then we got a contribution margin, which layers in the variable marketing or the customer acquisition costs. And basically you can kind of move down through the P&L looking at, revenue efficiency, cost of goods sold efficiency, marketing efficiency, and then indirect and overheads efficiency. And when we take your numbers or your ratios and compare them to your peers, it usually becomes very, very clear very, very quickly where our business is an outlier. And there's going to be probably some areas where you're doing quite well. And there's going to be one or two areas where you're doing a lot worse than the peers. So essentially what I try to help my founders with is identifying those areas where we're weak, figuring out a solution to that financial problem or that part of the financial statement that aligns with the competencies of the team and the business.
That's right.
And saying, okay, given the human capital that we have available, given this weakness that we have in our financial statements, how do we design a custom project that will most efficiently allocate these people to that problem? And so we can make a dent or try to improve this weak point in your financial statements, or your profit leak, if you want to.
Dang, Nate, that is so good. I'm going to ask something, and I don't mean this disparagingly, but it's like you're telling someone to eat their vegetables and drink water, right? To be healthy, to do smart things. Yeah. Do you run into maybe 28-year-old founder or 30-year-old founder, and they're just ripping through stuff, and you say something like P&L, and they just look at you like, what do you mean? I just made $400 million. What I care about P&L. Do you find resistance sometimes when you're trying to bring what I would call, and I mean this in a good way, a mature look at a business to someone who just found a little product to market fit and they are making millions right now?
Yeah. Funny you mentioned that guy who's ripping along and doesn't understand what a P&L is. I actually had a sales call recently with a 20-something founder. Told me a story.
There's a lot of them out there.
I'm doing a couple of $1 million in sales. I was like, okay, cool. Why don't we move to the next step of our dating process here? I'll do an audit of your finances, and I'll give you an analysis of what I think's up with your business. Can you give me access to your books? And he was like, books? I don't have any books. What are you talking about?
Here's my Stripe account. Oh, no.
So he has no idea how profitable he is, no idea how much money he's making.
What's his point of sale, though? How is he collecting money?
Shopify.
So he's back in Shopify.
His bank balance, and that's how he's managing the business.
Look, shout out to Shopify for making millionaires for people since 2005, I think. All right, but I digress. So you're talking to the young guy. And you say, let's take a look at the books, and he thinks, what do you mean, like a double entry ledger? I'm writing it with a pen.
Yeah, so I run into that sort of thing occasionally, and with the 20 and often the 30-somethings, I find that they often don't appreciate the benefit of wisdom and the scar tissue I have from making a lot of these mistakes myself. And I have a lot of trouble, honestly, convincing them that I'm not just a cost center and an expensive consultant to have floating around, and that I can actually...
I'm so sorry to interrupt you, but I want you, because this applies to... people will say sales makes the money, they generate revenue, finance costs me money. This is at every level. This is at your millionaire 20s to 30s. Just spend a minute. If you could, if someone was not going to get defensive, how do you tell them, listen, this isn't just something that's going to cost you $200,000 a year. This is why it's saving your millions of whatever. What's that story? What's that objection overcoming?
So I put it two ways. I usually encourage the founders to think about how much they're paying themselves. And I don't know, maybe the answer is a couple $100,000, $100,000, $200,000, I don't know. And then say to them, okay, you're busy, you're doing all of these projects, yet you're still not getting the growth, the revenue, the profitability that you want. Is it possible that a chunk of these projects and initiatives that you're pursuing are not actually helping you progress towards your goal? If we say yes, then I can say, all right, well, I often find that when I dig into this sort of stuff, I find that there's as much as 80 or 90% of the projects are the things taking up the founder's time, which are not focused on these strategic growth levers that we need to be focused on to improve your profitability. So if I could remove that 80, 90% of noise and instead get you 100% focused on the things that actually move your business forward, that basically puts a 5x multiplier on the value that you're contributing to your business. So you go from a $200,000 a year employee to $1 million a year employee in terms of the value that you're adding to your own company. If it's come out during the sales conversation, and I always make an effort to draw this out of them, I want to understand, like, what are some of the mistakes that they've made? What are some of the opportunities that they've missed out on as a result of not having the ducks in a row when it comes to finance?
Yes.
So another recent example, I have a founder who sells products through retailers like CVS. And she was telling me the story about how she missed out on this $1 million purchase order because she didn't have the inventory to ship. And I was like, oh, that's interesting. How much profit would you have made on $1 million? $700K. It's like, damn, that's a lot of money to miss out on.
Yes.
So the cost of you not having someone helping you with inventory planning and inventory financing, last year it cost you $700,000.
Yeah.
Let's look at how that compares.
There's a cost to too much inventory also, isn't there?
Absolutely.
I know in the US they'll tax you on it.
Yeah, absolutely. So, if I can find little anecdotes and stories like that, I always try to link that back to my retainer. And needless to say, I cost a lot less than $700,000 a year.
Yeah. I mean, but it's money. When I was with a $1 billion company, we would sell through partners into channel, very similar to the CVS story, and we were the manufacturer in the channel, and we had terms, so they needed to pay. They resold us, I guess is the best way of looking at it. They owed us some money, and they had already made a lot of money by reselling our service. And some private equity company came in and put like an interim CFO in, and he just went through and like redlined all the terms. He did something, and he was like, okay, we'd love to pay you this $4 million, but I need to negotiate the net terms with you. And he was trying to get it from like net 30 to net 90. And as far as I could tell, this guy's only job was to just beat us up on payment terms so that they could hold on to the cash longer in their bank account and pay that $4 million like when it made more sense to the company to pay the $4 million. Absolutely pissed me off. I was like, that's great that you're a brilliant CFO, but you are totally jerking us around. So like, and maybe the question I had written down that I wanted to come to is, what are some of those little mistakes that people might not have thought of? Like, not everything has to be net 30, and not everything has to be maybe paid in full. And so like, what are just low hanging fruit where you're saving people money right away? Yeah.
Probably the number one is understanding the difference between profitability or the P&L and the cash flow statement. It's possible to have a business that's profitable and cash flow negative. It's also possible to have a business that's unprofitable and cash flow positive. And this is particularly the case, or particularly amplified in physical goods. And I think this is one very notable area where the financials and the economics of SaaS or technology businesses vary quite significantly from physical products, is because in a physical products industry, we're obviously selling inventory, and usually our cost of goods sold is a much higher proportion of revenue. Not only that, we're not producing or manufacturing the cost of goods sold on a constant monthly basis. We're usually buying 3 or 4 months worth at a time, right? Placing a big purchase order, which might last us a quarter or 4 months. And so during that month where we're purchasing the inventory, there's often a very big cash outlay. And then we harvest or reap that cash back over the 2 or 3 months that follow. Now, you touched on something earlier, which was a very interesting point, and I want to circle back to here, which is that there's a cost of having too much inventory. And what I see incredibly often is founders that are overly focused on or put too much bias towards the profit, the profit and loss statement. So what that means is that they'll think about the unit economics. They usually understand their, gross profit margin, maybe even their EBITDA margin. But any physical goods founder who has lived through a stock out and been out of inventory and been unable to ship to customers who are rocking up wanting to buy has got some scar tissue from that. They're like, that was freaking annoying, right? Like, why am I bothering doing all of this if I don't have the inventory available to ship? I want to avoid a repeat of that situation. So the way I'm going to compensate for that and avoid falling into that trap again is I'm going to over-order inventory so that I have some buffer. Now, that doesn't usually have too much impact down to like the EBITDA margin. But some of the costs associated with having excess inventory is that you're paying more storage. You've got a higher risk of product obsolescence. It takes you a lot longer to pivot, change, or evolve the product, right? If you get some feedback, you're sitting on 9 months of inventory. It's 10 months away until you can ship that iteration or the packaging update or whatever it is that you need to do. And so you become a lot less responsive to customer feedback. In addition, a lot of the people in my world are bootstrapped, and so they're relying on debt finance to purchase this inventory. So more inventory means more debt, and more debt means more interest, and that's chewing away at the income statement just after the EBITDA line. So there's all of these costs associated with having excess inventory that founders are often not paying as much attention to as they should. And all of these things are just quietly kind of chipping away at the cash flow and the bottom line. And so they might be thinking, okay, this makes sense from an EBITDA perspective because I'm not having the stock outages that I experienced last year, and that's a good thing. Meanwhile, they're sabotaging their own cash flow and their own bottom line. And in my world, like most of the folks I deal with are cash constrained. Like cash is a bottleneck to their growth. And businesses that are managing cash and cash flow inefficiently are unintentionally putting a throttle on their own, growth potential. They're, slowing themselves down by doing that. That's a version of that story is playing out in probably 80-90% of the businesses.
Oh, for sure. I got the story from First Form, spelled with the P, and they're a health supplement company in the U.S. And the co-founder is Andy Frisella, and so he would tell the story better. I forgot where he told it, but they were early in their career. They had a beautiful new warehouse, and a buddy of his was their CFO. They just he worked up through the finance side, and they ordered a ton of inventory. And on the U.S. side, the IRS sent them this gigantic tax bill, and so they almost went bankrupt when he tells the story because they couldn't pay the tax bill up front, and neither him nor the CFO realized that that was also a factor in like buying so much inventory. I think my takeaway from that, though, back to you and the founders, is we all want to do what we love doing, right? Like they loved creating the protein shakes and shipping it, and there's so many blind spots that you don't think about. And I really think that that's where good advisors come into place to say, well, hang on, even if you would have timed your inventory purchase 3 months later, to be in a different fiscal year or something. That's questions that like experience, that's answers that experience get you more than like let's buy more so we can sell more. I am curious because you position yourself as a CFO, and I hear all of that. I also hear a lot of what I would call a COO, and then also what you presented yourself as a co-founder. I am curious if somebody was like, hey, Nate, I've got $500,000 in reserves right now or $1 million. I want to start something from scratch. Have you ever taken on work like that where it's just like, oh, let's do a quick assessment of your personality, the things that you like. Here's some products I've seen. Like, here's how you start a business. And if you follow this playbook in 24 months, you'll be at 4 million monthly recurring revenue. Have you ever looked at the market that way too?
So I used to mentor with an accelerator program here in New York called Food Future Co. And
are you in New York? I should have asked sooner. I apologize.
Yeah, I am.
Great.
Brooklyn, more specifically. Yeah, so I wouldn't say too many of them had 500 grand sitting in the bank account, but I did.
Yeah, but even
through
30
that-
grand, you can, I mean,
Yeah. Well, I did have a lot of experience with those earlier stage founders through that program. We were basically figuring out how to get them ready for their first round of institutional investment. And for people at that stage, really, it's about figuring out the set of experiments that you need to run and being as quick and responsive and strategic as you can about this playbook of trial and error and experiments to figure out something that works, figure out some version of product market fit that gets traction. In my consulting business now, as a CFO or co-founder on demand, we can maybe come back to that in a little bit. I look for businesses that are post-product market fit. And I don't really want to get involved in businesses that are pre-product market fit, because I am of the view that until you figure that out as a founder, you should not be allocating capital towards someone like me. Until you figured out how to scalably and repeatably sell to and acquire customers, there's no amount of finance intelligence that can fix a product that people don't want to buy. So go and figure out your product market fit. Once you've got that down, then come to me. I kind of specialize with in working with founders in businesses that are post that era, but not yet in a fully scalable real business. So all of my clients have got incomplete org charts. They're all trying to figure out how to build out the marketing department or the operations and supply chain. They're all trying to figure out what channels they should be on and what the product portfolio should evolve to. I enjoy working in that space because there's a lot of variety. There's a lot of diversity in terms of the problems we get to tackle. And really all I'm trying to bring to the table is, a level head, some analysis and strategic thinking, and trying to be the grown-up in the room to make, clear, rational decisions.
Let's play the org chart game. I'm very curious about that. So from your opinion of successful businesses, a founder came to you, there's product market fit. How much are they making? I'm curious, just roundabout. You're like, okay, I'm interested. What do you normally see missing? And then would you say, okay, listen, these are your next 3 key hires, and that kind of remains consistent across the board? Or is it ad hoc and bespoke for every business? Like, what is that org chart game where you say, listen, this is a critical role. You probably didn't even know it exists, but you got to hire it now, and this is where you go looking for it. Like, what's that org chart look like?
So the founders where I would start to get interested, and I think are potential clients for me, usually doing at least a few $1 million of revenue. They're often working with an media buying agency at the moment. And the agencies are doing fine, but they're often a little bit over obsessed or focused on things like ROAS, which I'm not particularly big
Cost
fan
per
of.
call.
And CAC. And they are good at telling the founders whether or not the ad account is working, but that doesn't often correlate with the business math working.
Yeah, for the audience real quick, a media buyer is like your marketing operations person that's sitting on Facebook, Meta, or Google, and they're like putting little creatives into the system. They're spending your money on the advertisements. I don't know why they started calling them media buyers, but it's been that way for a long time. Yeah.
It's a slightly odd term, but so they've usually got one of these agencies. They've been working with them for a while, and the agency is great at spending their money.
Yes.
Questionable about the results that they're generating.
And cool little dashboards about all the clicks you got. But
exactly.
I agree.
And what they really need is someone to come in and think like an owner from a marketing perspective, and think about channel allocation, think about messaging, think about the right way to actually build out a marketing team here. So I think a lot of these people are either wanting to or very soon needing to hire a CMO or, VP of marketing, someone like that. The other big area is on finance and operations and supply chain. Some of my founders, if they're, a little bit more spreadsheet and numbers savvy, will be managing this themselves. Some of them are doing an okay job at it. Some of them are doing an absolutely terrible job at it because they're just not numbers and data people. And so they're needing to figure out how to staff that operations and supply chain function, which is about procurement, figuring out, when and how much to order, then, the logistics, production, assembly, that side of things, how to put the widgets together, so to speak. And I see a range of people offshoring it. So I have one or two clients
offshoring the strategy or thought leadership?
Offshoring the operational side of things. Like if we can put it into an SOP, like if we can download...
Yeah, I'm offended.
If we can download our inventory report and look at our stock on hand, and if we've got some assumptions about, months of cover that we need to have, then you can potentially hire someone in the Philippines for $2,500 a month to manage that for you and place the purchase orders for you. I also have clients that work with US-based agencies that do this sort of thing. So you might be paying, I don't know, $5 to $7 or $8 for a fractional operations person to come in. Yeah. Then there's others who bring it, fully in-house, and then, you might be paying $10 to $15 a month for someone to run that department in-house. So everyone's trying to figure out the right way to put those pieces together.
Yeah, I normally ask you much earlier, but I've loved where we're going with this. Give us maybe a high-level view of, I think everyone kind of knows at this point, but who do you like to serve the most as far as like an ideal client? I heard a lot about, they're already making a couple million in the 5 million space. They've got X amount of SKUs. And then what do you offer? How do you position yourself in the market now? Like what's your kind of high level bio to help people know, oh, maybe I should be talking to Nate? Or, and then also like you did give a floor, but like, is there another way that you would say, and maybe at this phase, you're too early for me, or even at this phase, you're too big for me. Like, how do you summarize that for people?
Sure. A lot of questions there. I'll try to remember them all. Feel free to.
Who do you serve? How do you like to serve them? That was essentially it.
If I skip over it. So I like to serve founders who are in that third archetype. They're in the kind of business owner archetype, usually a bit more on the mature side, post-product market fit. They know, or that they've felt the pain of feeling the pain of not being able to make, smart financial decisions. I personally have a bit of a soft spot for like purpose or mission-led founders. I, like and respect people who are just, not producing the latest widget or fidget spinner, I don't really give two hoots about that sort of stuff. Like I like there to be some, greater social, environmental or health related cause behind what they're doing. Just from a warm fuzzies perspective. In terms of when they're ready, there's a few different, frameworks or ways to think about that. I mentioned the, 2 or 3 million number. I mentioned post-product market fit. But probably the more important framework here is about the number and complexity of decisions that we have to make about sourcing and investing capital. So as a business owner and operator, one way to kind of visualize or think about your role is kind of as an investment professional, right? A fund manager. Yeah. What I mean by that is you are sourcing capital from a range of different places. It could be debt, could be equity. You could source capital from customers. It's a great way to do it via sales. But you can also take money out of inventory, accounts receivable, accounts payable. There's a lot of different places that you can get funds. Then you have a whole lot of decisions about where you can potentially invest those funds as well. You can invest it in inventory, ads, people, new sales channels. The list goes on. So if you think about those two different as kind of axes, we've got number and complexity of places that we're sourcing money from, and then number and complexity of places that we're investing capital. And usually a founder is going to get more value out of working with a CFO when the number is high on both of those axes.
Yeah.
So I told you the story earlier about the marketing guy who was doing $7.5 million per SKU. I actually helped him build out a financial model, and then went on to talk about like a retainer relationship. But we eventually got to the point where I was like, I'm not sure that you really need my help, because you know where your money's going to come from. You know the two things you're going to do with your money when you get it, which is more inventory and more ads. Like, the range of decisions you have to make here is really not that complex. By contrast, one of my earliest clients was a lady who was running a beauty brand, and she also had a physical salon attached to it. And so she had an e-commerce business plus a services business. She was currently manufacturing herself, but needing to outsource and get, a co-packer or a 3PL. She was wanting to grow the services business, but that required more space than she currently had. So she was needing to rent space, hire people, figure out how to fill the chairs and so forth. And she also had, some family and friends with money. She had some grants she was looking at.
Yeah.
Anyway, she had a lot of freaking
She's got a lot of
options.
good problems. Yeah.
A lot of interesting problems. And she was a fraction of the size of the other guy. But I ended up working with her for quite a while because I felt like I was able to add a lot of value. And the number and complexity of decisions that she had was quite high. So I think, size, post-product market fit, and the complexity of the capital allocation decisions that we have are really the big indicators to me in terms of whether or not you need or will get value from a CFO.
You were calling yourself a future-ready CFO.
Yeah.
What does that mean to you when you're sharing that with prospects?
So the term future-ready CFO is really alluding to the fact that as a finance guy, I am helping founders get ready for the future. Essentially, what I'm trying to do is give clarity and transparency to the things that haven't happened yet, and give you as much visibility and resolution on the choices that you have ahead of you. The analogy I like to give people is you're hurtling down the highway at 100 miles an hour. If we can spot an obstacle or a pothole, 3 or 4 miles out, then we got plenty of time to gently adjust the wheel. We can swerve to the other lane and we can avoid that obstacle. But if we don't spot the pothole until it's 50 yards ahead of us, there's not much we can do at that point. We're probably going to hit the pothole, and it's probably going to be a really, really rough bump. So what I'm trying to do is keep the windscreen clean and trying to give you a set of binoculars so that you can see as far down the road as possible, because the further down the road and the more resolution that we can have on what's in front of you in the future, the better prepared and the more time that you will have to respond to it. And if that means that we've got a cash shortage coming up, that means we and we can see the cash shortage 9 months out, that means we can trim overheads, we can run a sale or promotion, we can take money out of inventory, we can potentially do a capital raise of some sort. We've got time if it's 9 months out. But if you tell me about that 9 days out, it's like, sorry, man, we're just going to have to
and
hit
again,
it.
what strikes me in hearing that is if a CRO gets the same information, the response is, we need to sell more now, always. That's the answer to everything. Is there something, you've said a lot of this over the last 50 minutes or so, but I'm still curious, is there something that jumps out as to a benefit or an item that someone did not expect? And so then they're with you for 30 days or 90 days, and they're like, dang, Nate, I thought I was just getting financial discipline, but had no idea how beneficial this part would be to the CFO relationship.
So I've actually just posted a couple of testimonials on my website from current clients that address this exact topic. Awesome. What you'll hear from both of them, and this is something that they were surprised by, and frankly, I was a little surprised by going into this, is they mentioned that it's a bit like just having a therapist for your business and someone with which, you can connect a couple of times a month, take a step back, get out of the grind, get your head out of the weeds and just think big picture and air your grievances. I'll listen to all their problems. I will, try to reflect back to them some advice or some observations or, some information. Sometimes it's a connection to my network. And a big part of what I do is honestly just founder therapy. I happen to be the founder therapist who can, also talk numbers and data with them. So it's like, I know you're overwhelmed. I know this is stressful, but let's just break this problem down. 2 or 3 simple parts here. We need to fix this first. This is how we're going to do it. Then we'll move on to this one. This is what the numbers say. This is what it matters. This is what we need to look for. And then we'll implement this part. And then once we do that, the problem should go away. Cool.
It really is like bringing an adult into the room. Yeah, entrepreneurs or founders, they take things personally sometimes. Where I'm just like, that was just data. Let's make a decision, move forward. Tell us more then. Where can people find you? You talk about who you like to work, but what would you like them to find? What's next steps you would want them to take if they looked for you? Plug those referrals by all means, website, LinkedIn, etc. Where can they come and get some of your help?
Sure. So futurereadycfo.com is the website. There you can learn a bit about me, my services. We've talked a lot about the one-on-one type stuff, which is kind of where I'm focused currently as a business owner. I think a little bit like you, Chad, I have aspirations eventually of kind of going up funnel into more digital products, courses, content, masterminds, one-to-many type products. I need probably 1 or 2 more retainer clients before I'm ready to delve into that.
That's a good way of looking at that.
Then the other place to check me out is LinkedIn. That's the platform where I'm most active in terms of the socials. The name again is Nate Littlewood. Should be pretty easy to find, and I'm posting on there usually a few times a week.
Yeah, great post too. Very informative. Appreciate you, Nate. This was really a huge eye-opener for me. I consider myself an ops guy. I would have said a lot of the things you said from an ops perspective, but I don't bring with it the authority or backing of, decades of financial certainty too. And I really see the value in that. I could see now where I'm as an ops guy helping a founder make a decision, and then now I would know instantly, listen, you need to be talking to a Nate right now. You need to understand the financial impact, the consequences, the long-term stuff here. So really appreciate you sharing that with the audience. If you guys made it this far with us, I want you to like and subscribe for me, and I will see you in the next one. Thanks so much, Nate.